Right now, while you're watching this video, someone is making money off your money. Not a little money, not a symbolic amount. If you have $10,000 sitting in your account, the bank is actively using $9,000 of it right now, without your permission, completely legally. And what does it pay you for that? What? 0.01% annually. That's $1 a year. $1. And do you know how much the bank is making off that money? That's what this video is about. Because the system that was sold to you as safe storage of money is actually one of the most clever wealth redistribution mechanisms ever invented by humanity, and you are its primary donor. To understand what's happening to your money today, we need to go back to Amsterdam, the year 1609. That's when the Amsterdam Bank was founded, the first modern bank. And in the beginning, everything was honest. You brought in gold. They gave you a paper receipt. Wanted your gold back. You brought in the receipt. Everything 1-to-1. But then the bankers noticed something interesting. People rarely came for their gold all at once. On any given ordinary day, a maximum of 10% of depositors came back for their deposits. The other 90% simply held their receipts and demanded nothing. And that's when someone in Amsterdam did something that changed the financial system forever. He issued a receipt for gold that he didn't have. He just issued it because he could, because no one was checking. That's how what we today call fractional reserve banking was born. The idea is simple. A bank is only required to hold a fraction of deposits in real money. The rest can be lent out, can be invested, can be used to earn. And if you think something has changed since then, I have bad news for you. Let's break this down with real numbers, because this is exactly where most people start to feel a slight dizziness. You deposit $10,000 into your account. Under the rules that were in effect before 2020, the bank was required to hold roughly $1,000 in reserve, 10% of the deposit. The remaining $9,000 it could lend to anyone. And this is where the magic begins. Let's say Bank A lent your $9,000 to John. John bought a car. The car dealer deposited $9,000 into Bank B. Bank B holds $900 in reserve. The remaining $8,100 it lends to the next borrower. And so on, and so on. Your original $10,000 ultimately turns into $90,000 of bank loans in the economy. You didn't give permission for this. You didn't even know this was happening. This is called the money multiplier. And this is not a conspiracy theory. It's a standard chapter in any macroeconomics textbook. But here's what textbooks usually don't emphasize. In March 2020, the U.S. Federal Reserve reduced the required reserve ratio to 0%. This means that, technically, today in the United States, banks are not required to hold a single cent in reserve for every dollar of deposits. They hold reserves voluntarily, out of caution, because they want to, or because they don't want to become the next Silicon Valley Bank. But more on that later. Okay, let's talk about money, real money. Take JPMorgan Chase, the largest bank in the United States. $2.4 trillion in deposits. In 2023, JPMorgan earned $89 billion in net interest income. That's the money they made from the difference between what they pay depositors and what they charge borrowers. The average rate on a JPMorgan savings account 0.01% annually. The average mortgage rate in 2023, around 7%. The difference, almost 700 times. They take your money for free and lend it back into the economy at 7%. This isn't a business model. It's alchemy, legal, documented, built into the very architecture of the financial system. Alchemy. And I'm not saying banks are evil. Banks serve a real function. They connect people who have money with people who need it. They take on risk. But there's a question that few people ask out loud. Why do you, the owner of the money, get $1, while the middleman, the bank, gets $7,000? Fractional reserve banking works under one condition. All depositors don't show up for their money at the same time. When that condition is violated, the system falls apart in 48 hours. March 2023. Silicon Valley Bank, the 16th largest bank in the United States. $209 billion in assets. A rumor leaked on Twitter that the bank had balance sheet problems. Venture investors started pulling their money en masse. In a single day, customers tried to withdraw $42 billion. $42 billion in one day. The bank couldn't meet those demands, not because the money had disappeared, but because the money was working. It was invested in assets that couldn't be instantly converted into cash. SVB collapsed in 36 hours, the second fastest bank failure in American history. And this was not a fraudulent bank. This was a respected, regulated, audited bank that was doing exactly what the system allows it to do. The system just only works when everyone believes in it. I'm not telling you this so you get angry at banks. I'm telling you this because most people hand their money over to a bank, thinking the bank is doing them a favor. In reality, it's the other way around. You're doing the bank a favor, and if you don't understand the terms of that deal, that means the terms are working against you. Fractional reserve banking is not a conspiracy. It's not news. It's boring, documented, taught in universities' mechanics. But that's exactly why it's so effective. It's too boring to talk about, too complicated to explain at a party, too ordinary to seem like a threat. While you sleep, money is working. The only question is for whom. If you want to keep figuring out how the financial system actually works, subscribe, because this is only the beginning.